Again, just drilling on the point, plan ahead, work with the right people, ask questions, don't be afraid to, it's a very complex tax code and process. Don't be afraid to ask for help and ask for guidance through it.
Hi everyone, welcome back to my channel. I am here today with Bryson Blackwell, who is a wealth advisor and 1031 exchange specialist with Wealth Strategies Advisory Group here in North Scottsdale. So Bryson, welcome.
Yeah, thank you for having me. I'm happy to be here.
So before we get into this really engaging subject, and it requires specific knowledge. I'm just curious, what brought you into 1031 exchanges and real estate investments?
So that's a great question. Thank you for asking it. I've been surrounded by a lot of great people throughout my life. My family had strong ties in real estate and have been in the real estate industry for a few decades. All my friends and their parents were in mortgages or real estate or finance in one way, shape, or form. So I was always surrounded by it, but it was actually Robert Kiyosaki's book, Rich Dad, Poor Dad, that actually really got me off my butt to go out and start working and start my career. And so that book gave me the foundation that I have today of just understanding what it is to be an entrepreneur and what real estate does for you and the kind of wealth that it can create. So that started my real estate journey. And through my father and his endeavors and just my personal experiences in real estate, I learned more about 1031 exchange and the benefits that it provides folks and just the tax code behind it and everything, and it was fascinating to me. So over the past 3.5 years, I've really just delved in and understood the ins and outs of it. So now we're here today.
That's awesome. So for those of you who are not in the real estate industry, Robert Kiyosaki is kind of a cliche. A lot of real estate people actually end up in the industry because they've read his books. And I didn't know anything about 1031 exchanges until I read his book. So we have that in common.
Yep, absolutely.
So then Bryson, so tell us, what is a 1031 exchange? And also, what are the benefits to using it?
Yeah, of course. So 1031 exchange, it's a tax code that's been a tax code for about 100 years now. So it's not anything new. It's been around for quite some time. But ultimately, it's a tax deferral strategy or tax code that allows you to defer your capital gains taxes from one rental property by reinvesting into another rental property. Any real estate investor that invests obviously sits on that asset. It allows it to grow, let the rent grow, and over time it appreciates. Obviously there'll be some taxes that could be due, and the 1031 exchange allows you to defer it just like a retirement account would, like an IRA. It's a very, very powerful tool in real estate. Many investors use it and have been using it. It's been modified over the past few decades, but as it stands right now, it's pretty exclusive to real estate investment or business use, real estate. So.
Okay, nice. So correct me if I'm wrong. Let's see if I'm remembering my Robert Kiyosaki well enough. And that is, if an investor is making capital gains on a property and wants to sell that property, instead of then paying tax on it and then buying something else, he can keep what he would have paid in tax along with his capital gains, and then just be able to invest a much larger amount of money into the next property and theoretically make more money as a result.
Correct, yeah. Okay. So it allows more access of the capital that you are recognizing at any given sale. Given you follow the rules, of course, there's multiple rules and nuances that you have to follow. But in that scenario, it allows you to utilize more of the capital that's available in way of deferring that tax instead of paying it. And again, with 1031s, we're not eliminating taxes, right? It's not a way to completely get away from the IRS. It's just a way we can defer it at a later date. So when we're talking about wanting to reinvest, maybe go into a new market or buy a newer property that doesn't require as much capex and maintenance, that's the mindset behind what some of these folks are looking for when doing a 1031. But yeah, it gives you more ability and more access to that capital.
Okay, nice.
Absolutely correct.
So being that this is an incentive from our government, it comes with rules, right? Because they don't let us get away with much without rules attached to it. So tell us specifically how an investor would go about deferring taxes through a 1031 exchange?
Yeah, so number one, you have to work with what we call a qualified intermediary. A qualified intermediary is the disinterested third party that is going to essentially hold the capital within the exchange or the proceeds within the exchange while you go out and look for your replacement properties. They're not necessarily an escrow company, but they help set up the proper bank accounts for an investor to have those proceeds in a qualified intermediary account, right? So you cannot do a 1031 exchange without a qualified intermediary. That's base case. You consult with them before you close and get that set up prior to closing on any rental property. So that's really the first rule or line item you have to follow. After that, the qualifications of what you can reinvest in is also another consideration that you have to take or rule you have to follow. And that falls under what we call like-kind property. When we say like-kind property, that doesn't mean you have to sell a single-family home and reinvest in a single-family home. That means you can sell a single-family home and reinvest in a commercial building as long as it's for investment or business use.
So with a 1031 exchange, I know that there's a strict timeline that investors who are selling an investment property have to adhere to in order to defer their taxes while purchasing another property. So can you share what that process looks like and what the timeline is?
Yeah, absolutely. So the first key date is obviously your closing date, right? And that, again, you have to consult with a qualified intermediary beforehand, but
so closing date of selling the investment.
Of selling the investment,
okay.
Correct. So that's what we would call day zero. Okay. So from day zero or day one to day 45, so the first 45 days after you've closed on that property, we call that the identification period.
Okay.
So the identification period is the allocated time that the IRS gives you to go out and identify or write down the addresses of the properties that you would like to purchase, potentially. That doesn't mean you have to have them under contract or close within that 45-day period. That's essentially your shopping list and what you're going to work with throughout the exchange timeline. After day 45, you cannot add anything to that identification sheet. So it's very vital and important to do all of your main due diligence and going out and looking for houses and potential replacement properties within that 45-day period. And then from day 45, you have 135 days after that to close on your ID'd properties that you would potentially purchase. So all in, it's a 180 calendar day process. And the identification, how that works, which we can get into in a moment, but ultimately you don't have to purchase everything you identify. You can pick and choose, but it's all a part of that planning phase. That's pretty important in a 1031.
In the timeline for identification, the 45 days that the investor has to identify the next properties he or she would like to purchase with the proceeds from his or her previous sale, is there a limit to how many properties? Could I list, if I were an investor, could I list 100 properties that I might be interested in buying?
Yep. Yeah, so I mean, there's nuances behind that, of course, right? These are the rules we have to follow. And that's what we call under the identification rules in a 1031 exchange. So there's really three main rules that you have to follow. The first rule is what we call the 3 property rule. And that essentially means you can identify up to 3 properties at any given value. Again, 3 addresses that we potentially may want to purchase. Doesn't mean they have to be under contract. Doesn't mean that they have to be closed and purchased. These are just addresses that we would potentially want to purchase. And with the 3 property rule, you can, let's say you have $1 million property sale and you decide you want to do a 1031 exchange. So you have $1 million in a 1031 exchange to reinvest. You can identify those 3 properties at, let's say, $1 million each, and that would be compliant for a 3 property rule identification. If you were to fall into the next rule, which is what we call the 200% rule, that essentially means you can identify multiple properties, even more than 3. Say you identify 5, but you cannot have the value exceed 200% of the value of the exchange.
Oh.
So it would, in that scenario, right, $1 million property sale, you can identify 5 different properties, but the accumulated value of those properties should not exceed 200% of the value, so $2 million. So if you had 5 properties, say equally $400,000 each, that's how you would have to fall under the 200% rule. If you go above the value and the number of properties. Let's say you identify 6 properties and they're each $1 million. You've now fallen under what's called the 95% rule. The 95% rule pretty much means that you are purchasing, you can identify as much as you want, but you must close on 95% of what you've identified.
Oh, yeah.
I have never seen it. I mean, it's very, very, very rare. In order of the popularity of each identification rule, 3 property rules by far the most popular and the most commonly used. 200% follows that, especially depending on what you're investing in. If it's a multi-unit or multi-property type investor that wants to go into diversify into multiple different markets and asset classes, that would be a 200% rule kind of identification. But those are pretty much the way that we can identify. The answer to your question, yes and no. It just depends on how you want to identify and what you potentially want to buy.
Okay, nice. So when we're talking about identifying, so just one clarifying question, because I know somebody out there is wondering this. What if the 45-day period ends and the investor can't buy any of the 3 properties they've identified? Can they buy a property that they haven't identified with a 1031?
Unfortunately not.
Rules.
Unfortunately not. As much as I'd like to say there's a workaround, there's not. That's why we drill into the fact, do your due diligence early. Anytime you're considering a 1031 or you have a property that you think it may be an option or it may work for you, start looking into one, obviously how the 1031 works and the rules you have to follow, which is what we're talking about today, but also really understanding what do you want to invest in, what would you want to purchase, what market would you want to be in, and work with people like yourself and well-educated real estate agents that understand this process too, to know I can help you I can assist you with making sure this process is a lot smoother than what we've seen in the past, which, to your point, a lot of folks call me 60 days, 80 days into their exchange and say, I don't know what to do. I've exhausted my list. What do I do? I said, we have to look at alternative solutions at that point. So that's a really good question, and yeah, it's a big consideration that we have to look into.
Right, so you almost have to be doing your research before you decide to sell your investment property, so that your 45 days of identification period is enough time to have a viable deal.
Absolutely.
At the end. Okay, so speaking of identification, tell us what kinds of properties you can buy with a 1031 exchange, because I know somebody out there is wondering if they can buy a vacation rental for their family with this. So please tell us.
Yeah. So again, in the theme of just being regulated and how, a lot of different rules, the kind of property that you can reinvest in or purchase or sell is limited. So we call that like kind property. In order to be qualified for a 1031, if you're going and looking at like kind as a definition, like kind means that the intent and use of that real estate is for investment or business use. So this is not going to be something for a primary residence. We get that all the time. Can I do this with my primary? The answer is kind of. You have to convert it to a rental over a certain period of time, and but overall, high level, it's pretty much no, you can't, right? And then vacation homes, very gray area where you have to really, really make sure, because you can use some of these properties to an extent. There are rules that you have to follow on that end as well, but it's very limited on how much you can use it in a given period. So ultimately, when we're talking about like kind as well, a lot of folks think it's more about the asset class, right? Selling a single family, I need to reinvest in a single family to follow the rules of a 1031. That's not true. It's more so I can sell a single family rental and now reinvest in a commercial building or a farm or a retail property. So it's a lot more open-ended on what you can reinvest in.
So Bryson, I'm understanding also that, like you were saying, it's very creative in the way that investors can reinvest into like kind properties, and they can even buy parts of properties like mineral rights and such with.
Yeah, so the possibilities of being like kind property, there's multiple different definitions of that. To your point, mineral rights are a big space that a lot of investors look at as a potential option. We actually work with some oil and gas sponsors and operators that help facilitate that sort of transaction or transition. There's ways to go into real estate syndications with 1031 dollars. So, I mean, it's really just contingent on how much capital an investor may have to work with and what it is they truly want to do. But, it's important to understand that it's not a pigeonholed view of it must be this specific kind of property. It's a lot more flexible than what you may think. So,
Right.
You're absolutely right.
And when you think you only have 45 days to identify what you want to invest in, you definitely want to work with someone who specializes
Yeah.
in this area.
Yeah.
So along that lines, and I think the way that I learned about the mineral rights is it came from the question of what if you can't quite use up all your capital gains? What if an investor is selling, let's say, $1 million property, and they have that equity and they want to reinvest it, and the properties that they're looking at aren't quite at that price point, and they want to just top it off and spend all the money so that they don't have to pay any taxes on that capital gains. That's where getting creative with the balance comes in.
Yeah, we get that situation all the time. One of the big strategies that we utilize is the Delaware Statutory Trust model, which again is a structure that allows for an investor to do a 1031, sell a rental property, and go into a larger real estate syndication. There are qualifications for that, but that is a good strategy if in that scenario where we found a property for $800,000 on $1 million exchange. Now we have $200,000 left over. What do we do with that? And that's where there's alternative ways and creative ways to reinvest those dollars with 1031 eligible investments to help fill that gap and what we would call boot, right? That's called boot if it's left over in an exchange and doesn't get reinvested. Boot is taxable. So we can strategically replace that boot into other vehicles that'll achieve the tax deferral, but also be, a good sound investment depending on what an investor's looking for. So
Nice. We'll come back to that DST in a moment. I want to finish the actual timeline of the 1031 exchange. So we've passed the 45-day identification period, and then the actual purchase and closing of the new investment properties have to be completed in 135 days?
135 days from the 45th day. So all in from day 0 to day 180, it's 6 months. So it comes in phases. You can close well before the 45th day if you're able to do that. It's not like you have to close in that 135-day window. That's just from a planning or a rule perspective, that's the timeline they set for you. So 45 days to identify, 135 days to close, 180 days from start to finish.
Great. So I have to ask this question because I already know the answer to it, but I want everybody to hear this. So what happens if one of the closings is pushed and it closes one day after the 180 days?
In that scenario, that's where you're at risk of failing the exchange. And that's, again, one of the considerations you have to take when putting these deals together, going into contract and negotiating. After that 180th day, you're highly at risk of failing that exchange, and most likely are going to fail that exchange. And at that point, taxes will be due on the proceeds that you recognize.
Yeah, so
it's unfortunate, but it can happen.
in a nutshell, really important to work with a team of specialists and experts, and to be proactive in the process. So with that said, Bryson, what would you say is the makeup of the team that's going to make a deal like this go flawlessly?
Yeah, obviously qualified intermediaries is number one on that list. You can't do a 1031 without them, so they're very important during this transaction and transition. I'd say second to that, depending on the strategies you may be looking at going into, having a well-educated and well-versed real estate agent who knows the market, who knows the strategy, is super vital in this process, even on the sale side as well as the buy side, because again, there's a lot of rules we have to follow, and it's important that the folks you work with understand these things. I always recommend having a really good CPA that understands real estate. Is a very good foundation to have in anyone's portfolio, in their team, if you will. Having attorneys helps as well that understand tax and real estate, and financial professionals, which is what we do here at our firm, where we understand this strategy very well. But we understand multiple other strategies on top of that too to consult on how to best approach these sorts of liquidity events, because chances are these are one of the bigger liquidity events of most investors' careers, and it's very delicate. So you have to make sure you have the right people behind you. So I'd say between those 5 professions, that would make up a very, very strong team of people that can help you get through these processes and give you good advice. Good advice.
Achieve your objective of deferring taxes. So let's go back to DST.
Yeah.
So that stands for Delaware
Statutory Trust.
Statutory Trust. And I know you mentioned it as a good way to use extra boot or extra equity from the previous sale of an investment property.
Yep.
So obviously it offers partial ownership, but can you tell us more about that particular organization and who it would benefit?
Yeah. So just to clarify, it has nothing to do with Delaware. It was created under Delaware law, but it's not a strategy that's only in the state of Delaware. But ultimately, it is an investment structure that allows an investor to utilize their proceeds from a real estate sale, 1031, and 1031 into a fractional ownership of a real estate portfolio, or a share of real estate, if you will. So large commercial, institutional type real estate. The qualifications for an investor, they do have to be an accredited investor, which means that they're worth at least $1 million net worth, excluding their primary. And could also meet it through an income level, but those are things that we internally look at before we start delving into that topic. But
sorry to back up. So excluding their primary residence?
Yep, excluding their primary residence. So that could be a makeup of rental properties, cash, life insurance cash value, or brokerage accounts, retirement accounts, just a makeup of their net worth outside of their primary residence. And it's a really popular strategy for investors that want to go passive, that want to exit out of real estate management. We have, over the last few years, definitely, with the significant growth in the real estate markets nationwide that we've recognized, there are many investors that are either approaching retirement age or are in retirement, and they just want to simplify their portfolio, but they don't want to pay taxes. So that's where DST has been a really good solution for those sorts of investors, because it takes away the management duties. It still is qualified for 1031 exchange, and there's an income stream. So that's been a good solution for them. Or in your scenario where you're talking about having leftover boot, very, very popular or commonly used strategy to fill an exchange, because the minimums are significantly lower. There's no negotiation. There's no need to go purchase the property per se. It's really, the asset's already been purchased. The partial ownership, or the shares, if you will, are availably ready. So we can choose a specific dollar amount of what an investor may need. So it's just another planning tool that can be included in a 1031. They've been around for 20 years, so it's not like it's not as old as the 1031 tax code, but they've been around for a few years, and it's definitely another topic of conversation that may interest some other folks too.
Right, nice. So I'm just thinking also, there are, as you were mentioning, a lot of investors that are maybe wanting to get out of actively owning investment properties, but also those that are downsizing and maybe want to start taking some of the income from their investment properties, and then, keeping some of it invested, but they also want to take some as income and pay tax on that as they take their investment portfolio down. I would imagine DST would be a good tool for someone wanting to do that as well.
Yeah. And doing a partial 1031 is absolutely viable as well. There's no rule around having to do the entire exchange or the entire value per se. So it's definitely possible. And a DST could just fitting the need of what a investor may want when talking about having access to more liquidity and more of that capital. Pairing that with a DST could absolutely be a viable option.
Okay, nice. All right, so we have the ins and outs of 1031 exchange. We talked about the timing of it, the kinds of properties that are allowed. Now I want to know from you the top mistakes that you see people make when they attempt this type of transaction.
Timing is one. Obviously, there's pretty big timing constraints that we have to fall within. I'd say the lack of planning is a big mistake that a lot of folks just set the exchange up and think we're in a good spot, we'll start looking, but 45 days is not a long time. It's really not a long time, so we always encourage to do it well before. One thing that we hadn't covered yet, but one of the other considerations with a 1031 is that you aren't just replacing the equity in a real estate transaction for a 1031. You're also replacing the debt. If the whole rule is you have to replace the entire value of the exchange or the property to get full tax deferral. So let's just keep using our example of $1 million property sale. Let's say when we closed, there was $500,000 in equity and $500,000 in debt, or in the form of a mortgage that we paid off at close. A lot of folks think, I just have to reinvest the $500,000 and all my taxes are deferred and my exchange is complete and everything's good and dandy. That's not the case at all. You now have $500,000 that is going to be taxable because you didn't replace the full value. So that's a big mistake that we see all the time. We always drill that. And that's one of the first questions we ask. Is there debt on the property? And we always get, yes, but it's paid off. We don't have to worry about it. I say, nope, we do have to worry about it. So that's a big mistake that we've seen before in the past. And I think between that, those are some of the more common ones that we've seen. Again, just drilling on the point, plan ahead, work with the right people, ask questions, don't be afraid to, it's a very complex tax code and process. Don't be afraid to ask for help and ask for guidance through it.
Right. I was just looking down at my notes. I think you covered everything. So hopefully everyone out there has a clear idea of what the 1031 exchange at least looks like and what the timing looks like, and more importantly knows that it's really important to work with a team of experts to bring one of these transactions to fruition. It's certainly beneficial and it's worth the extra energy to defer those taxes, so you have more money to keep investing. So Bryson, thank you so much for your time.
Thank you for having me.
It's been really enlightening, and we will have Bryson's contact information in the notes for any of you who want to reach out to him. I highly recommend that you do. And thank you all for watching. And if you would like to see more of this content, please like, share, comment, or subscribe. We'll see you next time.